Hello everyone, my name is Kamal Manocha. I represent PM IST World. First of all, apologies for 2 to 3 minutes delay. There was a technical issue. Now straight away I will come to the point. Today's webinar is a very special webinar where we are going to cover one product. We have not been doing much webinars particularly covering products, but this particular webinar is going to cover a product because we have a conviction with regards to this particular product. And just to give a perspective to all the new guests that we have in our audience, as well as to you, Anant and Nimesh, that we have been running one series, webinar series, which has been running very successfully by name Crystal Gazing: Next Decade of Wealth Creation for Investors. And in this regards, this particular webinar is also very important because we understand that to create wealth, kind of a horizon of 10 years is required. And in this particular webinar, we are going to cover about the emerging opportunities in equities, which are going to deliver wealth creation for investors over next 10 years. And I will also give a perspective that today, this webinar that we're going to do is with ASK Investment Managers, which is a very reputed, very well-known asset management company. A portfolio management service structure was, I think, pioneered by very few names like Motilal and ASK. So ASK is one of them. Today, if anyone is holding ASK's portfolio management service, they have understood the kind of resilience those stocks have shown during tough times, the kind of returns they have generated, the kind of alpha it has created. And one of the, I would say, proofs of that is that last year we had done awards with IIM Ahmedabad as our knowledge partner, and ASK's portfolio management service, which is India's entrepreneurial portfolio, won award both in the 5-year as well as in 10-year category. And those were awards which were done on the basis of risk-adjusted returns, where not only return, but risk, was also measured. And return per unit of risk was the parameter on the basis of which awards were given. I would quickly now spend, another minute to introduce Mr. Anant Jalan, who is the fund manager of this particular alternative investment fund, which is being launched by ASK, and the topic of discussion for today. Anand comes with 20 years of experience, and particularly he has been working as a fund manager, managing India-focused fund for last 4 years as part of Goldman asset management team in India. And before that, he was based overseas doing the same thing. And before that, if I talk about his qualification, he has done double honors, one in computer science and the second in economics from Pennsylvania University, Wharton Business School. So, be it experience, be it qualification, it's absolutely, I would say, excellent. And here we have Anant Jalan managing this fund, which we are going to discuss today, which is Emerging Opportunities Portfolio. And with him, we have my dear friend, Nimesh Mehta, who heads product, who heads sales, who heads business development. And, he has been part of ASK's investment managers team since its beginning. I know Nimesh since, I used to work in Citibank. So it's a old relationship that we have with him. And he also brings with him more than 2 decades of experience. He's he's an author, very well-known author. I think one of the best-sellers book on Amazon has been authored by him. We will talk about that also in this session. Over to you guys. And just to give a context, that we'll be starting with a presentation that Anant will cover for maybe 20 minutes on India's entrepreneurial portfolio, and then we'll do one-on-one discussion covering some of the real questions that investors always have given the current markets and given the strategy. Over to you guys.
Lovely. Thank you, Kamal, for the kind introduction. Would love to sort of go through the presentation. If you could upload it for us so that we can go through it. Great. So, hi everyone. Thanks for having us and listening to us. Kamal, we can go to the next slide. So, we just introduce ourselves a little bit. I'm sure you're familiar with ASK as a house, probably worked with us, invested with us in the past. Equity-focused house. We do just equity, long-term equity investing. Pretty strong team, deep research, very team-based approach. And I think what's unique somewhat is that we're not just focused on maximizing returns, but as Kamal mentioned, risk-adjusted returns, capital preservation. So, that's very important for us, a little bit more of an absolute return kind of mindset from that perspective. Kamal, if you can, okay, I can shift the slides here. Okay, great. So this is just a quick update on sort of our investment philosophy. We'll just touch upon the key elements really quickly. The first thing that we look for when we're picking any stock, any single stock, we look at the size of the opportunity, right? So we want an industry that is growing, where the size of the opportunity is going to be a lot bigger many years from today. Within that, if we can find elements where the leaders will gain share in that industry, either because you're weaker competition or some other factor, then you can have even faster growth where the industry itself is growing, but within that, the leading players are gaining market share and so growing even faster. So that's the first enabler we look for. The second is the quality of the business. Here again, we are looking for capital efficient growth. So growth itself doesn't translate into value creation. The growth has to come in a capital efficient manner. And the only way growth can come in a capital efficient manner is if the company has some sort of competitive advantage. So we're looking for competitively advantaged businesses that have moats around them. And ideally, as the business grows and scales, the moat gets stronger and deeper. And most importantly, the business should be sustainable. It should have longevity. It shouldn't be based on some fad or some short-term thing that is not sustainable. So that's what we're looking for. Then in the middle, we have management, which is, of course, the most important. Just like our investors, we are the stewards of capital for our investors who invest in our fund. Management is the steward of the fund's capital. So when we invest in a company, management essentially takes decisions of what happens with that capital. So we need management that is very ethical, that is competent, that is hungry, that has a focus on the long-term sort of value creation. So when you have these three in place, which is size of opportunity or growth, quality of the business, and quality management, I think what that enables is compounding in earnings, right? So that gives you high quality earnings growth over time. And that's essentially what sort of creates value over time. And as a long-term investor, that's a very, very important characteristic to have in all of the stocks that we pick. The bottom of the chart is value, which is extremely important as well. So we need to, whatever we buy has to make sense. There has to be a margin of safety. The price we pay has to make sense. Again, here, a lot of the market uses there were different ways of looking at valuation. And, we try and look at valuation differently for different companies. So, one of the most commonly used valuation measures is like a price to earnings ratio, right? Which is an approximation of the value of a company based on a point of time earnings. Let's say next year's earnings, you multiply it by a certain multiple to come up with what you think the fair value of a company is. And that works for certain industries, certain types of companies, where the next year's earnings is a good approximation of the future earnings power. But really the value of a company is, the present value of all the future cash flows of the company, right? So you could have instances where, the cash flow earning potential 5-10 years down the line is much higher than what the current earnings are. So using the near-term earnings will give a wrong picture of the value of that company. You could also have examples where, earnings is not the same as cash flow. And so using an earnings multiple, does not give you a fair value of sort of fair picture of what the value of a company is. So, we try and look at valuation from different metrics as well, and sort of try to figure out what we should be paying or what a company should be worth. Introducing ASK Emerging Opportunities Fund. So this is the fund that we're here to talk about today. Essentially a flexi cap portfolio with a mid cap bias. So what we're trying to do here is buying leading companies in emerging industries. So the bottoms up philosophy that ASK stands as a house and that applies to all our existing portfolios, whether it's IEP or some of our other larger portfolios, is exactly the same. So very bottoms up focused, looking for the same things, size of opportunity, quality management, quality business, All of that is very consistent and the same. I think what's slightly different is that we are looking for companies that are leaders, so they're very high quality companies, but they are in industries that are emerging. So the industries themselves might be slightly smaller today, and because of that, even the leading companies or the dominant companies within that industry just happen to be slightly smaller market cap companies today. We fully expect that in the future, given we think these companies have a very promising competitive position and the industry itself is very attractive in terms of size of growth, we think in the future there will be these companies may be large caps. So we expect and hope that a lot of these companies that are sort of leaders today but are mid caps will be the large caps of tomorrow. So that's the thing. I think the other thing that I would like to add is that our stock selection will not be on the focus of market cap, right? So I want to make that very, very clear. Just because this is a mid-cap bias fund, we will not select companies just based on the market cap. So what do I mean by that? There are certain industries and sectors where we think large caps have a big advantage. Something like insurance, we think larger companies are better placed to capture opportunities in insurance. Something like consumer lending or financial services, we think the larger companies in that space are best placed and best positioned. So when it comes to investing or participating in those opportunities, we would go with the larger company. So we would only pick the sector leader. We would pick companies within a sector that we think are best positioned without looking at sort of market cap. So these are just some examples of what I just spoke about. So what I spoke about, that industries themselves are emerging and market leaders within those industries just happen to be sort of smaller or mid-cap companies today. So just run through a few examples just to give you a flavor of what I'm speaking about. So in the specialty chemicals, agri-chemicals, API space, companies like RT Industries, PI Industries, these are leaders in what they do, and they still are sort of in the mid-cap range, right? Because these industries themselves are emerging. So chemicals until now, if you look at sort of the global position of chemicals or manufacturing of chemicals, China has traditionally dominated manufacturing. 50+% market share in many type of global market share in many types of products. A lot of that has been changing over the years. Western buyers are more cautious about dealing with China. Events like the pandemic have made Western buyers realize that you cannot depend on just one country for your entire supply chain. They saw the sort of supply chain disruptions that have happened and are still happening, honestly, because of shutdowns we saw in China, etc. China itself is evolving, right? So as China evolves in its economic journey, they themselves are less focused on certain types of manufacturing and focus in other parts of the economy. So what all this means is that market share that China has over time will shift to other countries, and countries like India that have very strong sort of manufacturing capabilities, especially in spaces like chemicals, has a strong end market, right? So India is a big end market for pharmaceuticals, chemicals, autos. So all of these, because of that, we already have the manufacturing scale and know-how. And so, Indian companies will benefit from that sort of a trend that's happening where China is ceding share. Similarly, shift from unorganized to organized. So this is something we have seen over the years. It has gotten accelerated after sort of demonetization, then COVID, and now and GST, and now COVID. And so, this is a trend that has been happening, but as it continues to happen. And the good news for the organized companies is that there's still a lot of share to gain from the unorganized sector. So spaces like diagnostics, right? I mean, it's a space that itself on its own is growing at very high rates because Indians over time, as the prosperity and economic levels go up, there's more awareness about diagnostics, about getting yourself tested every year or two. And within that, leading companies like Metropolis are still only kind of 15,000 crore market cap companies. So still mid caps, even though they are leaders or clear leaders in the diagnostic space. Similarly, in footwear, Relaxo, which is 30,000 crore market cap, is a leader in sort of the footwear space, but still kind of sub 5% sort of market share if you think about it. So a lot of room to grow over time. Similarly, on the China plus one strategy, the other companies like in consumer electronic companies like Dixon, that that are manufacturing mobile phones, consumer electronics, etc. So, China still enjoys advantage when you think about electronics in terms of cost, right? The scale that China has is much bigger. It's massive, and with scale comes cost efficiencies, right? And so companies like Dixon today are still not fully competitive with China on cost. But I think what's happening is that because countries are being forced to look beyond China, they are willing to support companies like Dixon by paying a slightly higher cost today, knowing that over time, companies like Dixon, as they scale up, will match China's cost. And so you're seeing this shift happening where companies are shifting from China to companies like Dixon. And the government has very astutely stepped in here and come up with PLI scheme, which is nothing but production-linked incentives. So what the government is saying is that we realize Indian companies may not be able to match China on cost. So till they build the scale where they can match China on cost, we will incentivize them. We will subsidize their manufacturing so that the end consumer is not paying too much more and is paying something similar to what China is paying. And this gives a fillip to manufacturing in companies like Dixon. And over time, they will sort of scale up and match, become globally cost competitive. Similarly, digital, which is a very, very interesting theme, right? So if you think of, this is a trend that's been sort of happening over the last 20 years globally since the advent of the internet. India more recently picked up steam. I think enablers have been just smartphone penetration. So now smartphones are no longer unaffordable. Mobile broadband access is no longer unaffordable with the advent of Geo and all these data plans that have come about. From a product or service that was only available to 5% of our country, now more than half of our country can access high-speed internet over smartphones. And so what all that is meant is that it's sort of, giving a big fillip to the offline to online shift, and digital companies are benefiting to a large extent. So that's a trend that we think is here to stay, and we're in the very, very early stages of that trend. Other factors that support are that, India is a very young population. So, young users that are coming into the workforce today are pretty tech savvy and, are able to use these products and services. And also there's a pretty vibrant venture capital VC ecosystem that is funding a lot of startups in this space. And so with that funding, what it means is that the product or service is actually coming very affordable to consumers. So if you think of e-commerce, you think of other categories, the consumer is actually really benefiting because services and products are coming to them very cheap. And that in turn is causing rapid adoption of these services, right? So that trend is only here to stay. And the good thing about digital is that it scales very, very fast, right? So unlike physical infrastructure that requires factories, a little bit slow, digital, the adoption curve tends to be very, very rapid. And, with that rapid adoption and scale up comes efficiencies and cost efficiencies, right? And so what that means is that consumers will get a better service, more convenient, at a better price point, right? And so when you have those sort of enablers, it tends to be, it tends to catch on very, very rapidly because it's a win-win for everyone in the ecosystem. So these are just some examples of trends where, the industries are emerging. These are leading companies within the industry. So they're not me too mid caps, but they're still sort of in the kind of mid cap range because the industries are still emerging. I think this slide again highlights that how sector leaders and quality leaders are different from the typical mid cap. So I think what this slide shows is the bar in black is the overall EPS for earnings growth for the overall mid-cap universe, right? So the one on the left is FY 18 to 20, the one on the right is FY 21 to 23. So it shows that FY 18 to 20, there was a minus 3% EPS growth for the broader mid-cap universe. That makes sense. We've had a very tough macroeconomic environment. We've had demonetization followed by GST, followed by COVID. And so, mid-cap companies that are more marginal tend to have more volatile earnings trajectories. And so they have gotten impacted in this current environment. I think what's more important to highlight is the bar in gray and the bar in blue. which is the gray bar is the ASK universe that we track, which are more the quality companies, which have a market cap of less than 40,000 crore. So mid caps within the ASK universe. And the bar in blue is the universe of stocks that we would consider for our portfolio. So a subset of that bar in gray that we think are even better and even superior. So I think what's interesting is that even in this tough economic environment where the broader mid caps have declined by 3% compounded over the last 3 years, the quality mid caps that are sector leaders have grown anywhere between 20 to 30%, right? And so that is the more important sort of takeaway, that quality companies, that they're mid caps, but their earnings trajectories are not volatile like the typical mid caps have been, and the secular drivers are here to stay, and this reflects in future earnings as well. These are just slides that show sort of how some of these examples we've spoken about have done over the last 3 years. So we've spoken about the earnings trajectory in the prior slides, but what this shows is that the superior earnings have actually translated into market performance, and the market has rewarded investors for that superior business performance. So companies like APL, Apollo, Dixon, Bajaj Finance, Metropolis, IndiaMart, Radico, Solar, all examples of stocks that we would consider having in the portfolio, where earnings growth have been supported with investment performance. The next set of slides essentially just highlights kind of what ASK has done in this space over the last year. So over the last few years. IEP, which is currently our flagship scheme, when we sort of launched it in the 2013-14 period, we picked companies. If you look at the average market cap or the median market cap of companies we picked in IEP at the time, they were in the 16 to 20, 30,000 market cap sort of space, which is very similar to the market cap of companies in EOF that we're speaking about today. And so what's interesting is that these companies, while were mid caps then, are the blue chip leaders today. So this just goes to show that, as a house, we have done this, and the next few slides will show kind of examples of that. So, companies like Pidilite, Bajaj Finserv, Bajaj Finance, Astral Poly, PI, Asian Paints, Page, these are all examples that we picked kind of pre-2015 when they were mid caps. And many of them are still in our portfolios today. We're a buy and hold kind of investor. We believe that these companies still have a very, very bright future ahead of them. And so we continue to hold them. But the point being that when we bought them, they were mid caps, but they were leaders in what they did, and they were quality leaders in what they did. And today they are large caps. And our hope and endeavor is that, we pick the companies we pick in EOF, sort of have a similar trajectory. And when we speak, 5-10 years later, we have similar success stories to highlight. A little bit on the portfolio construct. So, 25 to 30 stocks is what we're looking to build the portfolio around. So an average weight of around 4%. One of the things that we do at ASK is sort of run more of an equal weighted type of portfolio. We don't run very high weights on certain stocks and small weights on certain stocks. The idea is that we want to have all of our portfolio constituents contribute to return. So, we have conviction in all of our holdings, and having 1 or 2% positions, we don't do. This is our filtration process. Essentially, as I spoke about, our quality filters apply. And so while we first cut on management quality, we filter down on ROCE, earnings growth, and that gives us sort of a universe that we can pick from. And then we pick the companies from that universe that we believe have the best prospects. Quickly run through this. So again, just from a risk management perspective, as I already mentioned, we don't run very, very large concentrated weights. We run an equal weighted portfolio. And even from a sector perspective, we tend to have diversification. So we won't have, while some of these themes we spoke about are interesting themes, there will be diversification within those themes. And no one sector would have very, very meaningful sort of contribution or risk contribution. Some terms of the fund, it's structured as a 7-year fund, but more important from an investor's perspective is that it has a 2-year lock-in, and between year 2 and year 5, there is a small nominal exit penalty, and 30% of the commitment amount or the investment amount will be drawn at initial closing, with the balance to be drawn over time. So those are the key points. Nimesh can chip in if I missed anything, and these are the sort of broad indicative fee structures. So I think I've hit pretty much exactly 30 minutes, Kamal. So I hope I'm in good time and we can get into questions and answers.
Absolutely. I think the presentation itself covers most of the questions, but we will ask the questions that have come on chat and that we have got from our clients.
Sure.
So first of all, the foremost question is a very obvious question that at these higher levels of markets, which most investors are kind of now worried about, especially in the mid and small cap space. You guys have come up with a product which is focused on the mid and small cap space, maybe particularly mid cap space. And though last 10 years, if one sees and compare the performance of multi-cap funds or mid-cap funds, it is evident that the multi-cap funds have actually delivered better returns than mid-cap funds. I'm talking about entire 10 years. Maybe last 10 years was a period where India's economy did not grow, and that is the reason why mid-cap funds have relatively underperformed. And the experience of creating returns is also equally important. The experience of returns generated by multi-cap funds are far more superior than mid-cap funds, and that recency bias is what makes investors kind of feel little disturbed at these levels in investing into a focused mid-cap fund. Though obviously investors understand that with a 5 to 7 year kind of horizon over next decade, investors have a potential to make good wealth, and you guys will be investing in good quality businesses. However, still there is a concern because market levels are high, and this is a mid and small cap focused product, and there is a lock-in involved. So how would you address, what are the house views of ASK regarding mid and small cap, regarding valuations, and what is your perspective? How would you want to address investors' concern in this regards?
Sure. So I'll take a stab first, Nimesh, and you can add. I think the first point I would like to highlight is that this is not a typical mid and small cap fund. It's a flexi cap fund with a mid cap bias. And we are looking to buy companies that we think on business characteristics and strengths are at par with some of the large cap funds that we own. So anything that we own in this portfolio, we would have wanted to own even in a large cap fund liquidity rating. So it's not as if we are picking names, carving out a universe from things that we would not like to do. I think the anxiety that investors might have on things having done well, a little bit of the anchoring to performance is valid. Cannot blame investors for having that sort of having that bias. But I think what I would like to highlight is that while overall markets have done well, so if you look at last year, maybe Nifty was at 12,000, today it's at 16,000, so it's up 35% from that perspective. I think a lot of factors have also happened, right? I mean, the cost of capital has fallen. So what is the value of a stock, right? The value of a stock is nothing but the present value of its future cash flows. So future cash flows and discount rate. These are the two things that determine the value of the stock. So I think while the outlook for future cash flows has remained as stable as ever, in fact, in some sectors has only improved, the discount rate has certainly fallen with the cost of capital globally. And so some of that improvement in overall stock market valuations is driven by that, which we think is justified and sustainable. So I would say that on the overall market level. And I think, one has to take a view that the near term, 6 months, 12 months, frankly, no one has an ability to predict. Are we at a peak? Can we see a correction? It is possible. No one can predict. I think what we try and do as asset managers is pick the companies that we think offer superior prospects over a 5 to 7 year period and buy them, right? And it's our belief that over time, if we pick the right companies that are delivering compounding in earnings, compounding in intrinsic value, over time, the market will recognize and reward that. And, so from that perspective, we think that given the prospects I spoke about in the industries, the examples I gave about are pretty bright. We think, the room for that consistent compounding in earnings is pretty healthy and exists. And so, from that sense, our style of buying quality companies, the duration really helps. And so price will be one determinant of return, but the bigger determinant of return over 5 years will be the companies you pick and how much they can compound in value.
Sure, sure. So Nimesh, there are some of the questions, subsequent questions to what Anand has discussed on the chat. I can read. So things like what are the near-term risks that you see in the EOP portfolio, and what is the house view of ASK on markets over next 5 years? Is it the right time in terms of entering into mid cap? These are some of the questions that I can see on chat, which are linked to the answer which Anand has given. Maybe if you can address some of these questions.
Okay, so let me just move to a few slides to address a few questions which you have head on, because I think client has hit a question which is very relevant. 1 minute, because I don't know how to move fast here on this slide. I'll have to run. I was just doing this presentation to a previous customer as well, and the similar questions came in. So I thought let me load this for all of you and share with you how this whole works. Sorry. Yeah, so I'll just start with this, and the questions with regards to came on the market in terms of what the market levels are, and second in terms of what came is the mid cap levels. So I have a few slides to share, and the first thing before I share is this quote has always inspired me in equity investing, and it's said by Desmond Tutu. It says, "What we learn from history is that we don't learn from history." And why do I say so? I just want to take the clock back to March 2020, and everybody thought that if you have picked up the pink papers or in a media articles, everywhere it says that it will be a U-shaped recovery. We're in a bear time for next 2-3 years, etc., etc. And then just look a few months. I'm just looking at the time and moving faster. If you look here, the best of the experts in the market. So if you see, I can't project. If you see Morgan Stanley in March, April 2020, put the target to Sensex cut down to 32,000. Then the same day, in the Goldman Sachs put down to 10,000. Now I have very high regards to these firms. I'm not saying at all. If you see 6 months later, in November 2020, Morgan Stanley moved the December 21 target for Sensex to 50,000. For Goldman, increased it to 14,100 for Nifty. And in this year, actually they moved it to 61,000 and 16,300, which already crossed. Now, why I'm sharing there is that it is, to the investors who always invest, it is, very rare. And I'm saying this is the highest regards for this firm. We ourselves have gone wrong. It is difficult for anyone to predict where the markets are going and how it will pan out. Like in the next year, in the next slide, if you do, we had studied the history that whenever the markets have fallen more than 30%, there have been about a very significant bounce back into the Indian markets. And till last year, so what it says is which year it had fallen more than 30% and how it has moved. Last year when it fell 38%, if you look at that, we obviously had put a question mark there. It has up 107% bottom. But again, history has taught that when markets fall, then one should participate, be greedy, and whoever participate has been able to benefit from it. Now, this is, what we say is time in quality portfolio is more important than timing. Because in the last 16 months, Nifty has, fallen more than 2% for 17 days, and Nifty has gone up by 2% in a single day for 19 days. And therefore, if you add up 36 days out of 300, 400 days, 10% of the time, Nifty was up and down. Could we have got it right? But if you're an investor in IEP portfolio, which, Kamal mentioned about it, you would have lost 22% if it had just not been there for 5 days of that portfolio. So it's very important that all of us should stay invested in quality and not dabble into going in and coming out. Now, this is a slide which I picked up from Psychology of Money book. It's very, very powerful what Morgan Housel has put there. See, Buffett, is great at investing, but look at his wealth creation. Today, his value is $104 billion, but fully $101 billion of his money came after his 65th birthday. Just support Buffett has done what we had done, started at 30 and ended at 60, what we do to play golf with our kids. He started at $25,000 actually, and returns for him was 22%. What would have been his value if it had retired at 60 age? It would have been $12 million. Can you believe it? Today, his value. Buffett's skill was not about just investing, but the skill was in the time he put in there. So therefore, more than 99.9% of his wealth came from sticking around longer than the average investor. So the question investors should ask to each one of us themselves, that are we longer in the equity or are we shorter? I'll run last two slides, but very, very powerful. This is my real learning, and I brought this is very powerful slide for all of you to study here. So this what it says is IP strategy. The first column says when was it high last time around, then March 20 fall, then how much drop it happened. I'll just take you through. So 55 rupees was a NAV, which was a peak in 14 Jan 2020. Most of the clients today feel that we are at the peak of the market. People said that we are at the peak of mid cap and large cap or whatever in a small cap. We ourselves didn't know that 55 rupees was a peak of IP, but the peak happened for the market in March 2020. Now look at the fall which happened. 38% fall happened. So the client's value in our portfolio came down to almost like 38 rupees, which is 31% fall. Imagine in about 15 days, the value eroded by 31%. But investor who stayed in the equity portfolio in the high quality, on November 30th, the portfolio value came up before the previous high at 61 rupees, which is 61% up. So when I was present to the clients in October, November 20 last year, clients asked me, how can there be dichotomy? On one side, equity markets are going up and coronavirus infection are going higher. There's a complete dichotomy. And to that, I answered a question, and even that relevant today, that equity markets are 95% future and 5% present. Investors are always 5% today and 95% present and 5% future. Equity markets are thinking what 2022 holds up for us, and therefore it's always in the future. But investor thinks, "Arey, bahut price बढ़ गया." Couple of my friends who are close to me sold off their portfolio in October, November 2020, believing that the rise up is 61% in the 6 months time. So will it sustain? And it's a real story. From there, it has gone another 30-40% up. So from the peak of last time, which is IP, from 55 rupees today, the NAV is 78.5, which is up 43%. So the investor on Jan 14, 2020 felt that IP was at peak, and today the same journey happens, he believes it's peak. But look at, in the hindsight, we realize that the peak is only known after it has been made. It's never been known. If you look at some of the names like Asian Paints, from 1800 rupees price, it has moved up to almost like a 2000 or 3000 rupees, which is up 63%. Or Bajaj Finance up 49%. PI Industries up 100%. So to my last slide here, which is where I'm answering Kamal's question. Customers believe mid and small cap has moved up very faster, and therefore should we enter? So this is something we have in our portfolio, which is PI Industries. And I was saying, should we buy if the price keeps going up? So if you see here, a 1 crore invested in PI Industries about 28 years back. Can you believe it? What's the value today? 2,521 crores. Unbelievable, right? At a compounding of 31%. You can just do the maths for yourself. But what I'm bringing, not that maths here, but look what would have happened. In 2016, it was up. The price was 892, up in a single year 30%. So the people will feel mid cap बहुत बढ़ गया है यार, PI is बढ़ गया है. But next year is up 10%, then up 4%, then 49%, then 62%, then 29%. For the last 3 years, continuously it's keep going up. And therefore, if you keep focusing on the price, then you'll miss out on the great opportunities. And so many investors in India have not created wealth because their obsession has always been onto the price to earnings. And therefore, take some learnings from what Buffett taught us. Take some learnings from the IP slide, which I showed earlier, staying invested in high quality portfolio, and from this slide, which is where the mid caps keep growing. And therefore, if we have the framework which ASK has, the size of opportunity, the quality of business, the quality of management, the earnings growth, and then comes valuation. If we focus on the 4 things, the price will catch up. So let's not focus on that and build. This is a great times to build a portfolio. We believe next 10 years will probably create more wealth than what is even created in the last decade. So I'll just stop here. Sorry, Kamal, it was slightly longer, but I thought it was relevant for every investor to know that.
No, absolutely. It was quite, insightful, and I think the best way you have attempted to answer this question. And now, next question pertains to the fact that because one is ultimately going to, I would say, devote, say, a period of 7 years into mid and small cap or a flexi cap fund, which is into emerging opportunities, right? So with this kind of horizon and that too on AIF structure, there are other popular options available in the market, which are like pre-IPO funds, right? So, and investors tend to compare investing in the space of pre-IPO funds for a similar horizon on a similar structure with, say, investing into this space. And as you rightly mentioned, that because we as human beings are always more worried and more focused on price, and since prices are all-time high, it looks like that investing at listed space, is relatively, I would say, difficult than maybe getting into a pre-IPO space where we do not know what is the price,
Yeah.
right? So though it is much more opaque, how would you, answer to this question for investors?
Yeah, sure. So first of all, I wanted to share that the tenor of the fund, I'll explain what is there. It is 2 years close-ended after the final closing, which will happen next year. And then it's a 3-year exit lot protected. So the way it is defined is only it's a 5-year strategy and not a 7-year which gets pursued. I'll repeat for all the investors' benefit. 2 years close-ended, then 3-year exit lot protected, and after 5 years, it's an open-ended strategy. So generally, in my experience, has been that most of the AIFs in the market are roughly about 4 years. So it is just 1 year more than what the others would be there. And therefore, it is not really, really long. Now, you mentioned a couple of, other strategies or other things. So I will just share, go through my own experience. And to me, the proof of any concept in investment portfolio is in the returns. Now, in my experience of meeting investors over the last 15, 17 years, I haven't heard any investor make great or I would say good returns also at the portfolio level in the pre-IPO or a late stage equity space or a private equity space. So I think it is, while we don't have the capability, if investors feel that they have a good opportunity, they do participate. We believe we are good at what we can do at a listed marketplace. And I would bring one more factor here, that when you come to equity markets, we all should come with a 5-year plus view. Even on the PMS side, when we talk to our investors, we generally tell them, if you have a 5 years view, then come to us. Because we believe investing into equity market is nothing but investing into your own business. When you come into a business, you don't enter and exit in every couple of years, right? Because business takes its time to build. And just like you stay in the business for longer, my request to all investors would be to see that anything which you do, a PMS or an AIF, come with a 5-year view. And I would say you would get much better returns than what you possibly get in your own business. By owning other business, you possibly get there. But if somebody wants, as Kamal highlighted, if somebody wants to invest into some other kind of strategies, I think Kamal and team will help you in identifying those opportunities.
And I would just add that I think the two opportunities are very, very different, right? A pre-IPO opportunity is not betting on business fundamentals. It is betting on a deal dynamic that I can get into a company that's just about to go public, and there'll be a pop at IPO, and so I'll make money, right? And there are risks that come with that. For example, we don't consider the risk. What happens if you invest in a pre-IPO and the market turns and the company never goes public? You're stuck with a fully illiquid position, right? So there is a big illiquidity risk that is there in that. Versus in this fund, we are buying listed securities. The fund itself might have a 2-year lockup, but securities themselves are sort of constantly liquid. And I think very different strategy. So ours is more of a fundamental, bottoms up, buying good businesses, staying invested, compounding with those businesses, which I think honestly has stood the test of time, right? Across market cycles, across geographies. So it's a very time-tested principle that sort of makes sense on a first principles basis. And so somewhat different, but I just thought I'd add those points.
No, it's very relevant. And Kamal, I think this one also knows our oldest growth portfolio today, which is tested the times of 2 decades. A crore invested in Giant 2001 today is worth 45.7 crores, a compounding of 20%, where the Nifty is compounded about 12-13%, and that value is about 12-13 crores. So that's in terms of the listed equities experience we bring in and the track record we bring in.
Absolutely, and I would also like to add to this particular question. In case of pre-IPO fund, out of the total life of 5 years, 2 years actually go in searching and doing the investment in the pre-IPO space, and only 3 years are given to the investment for one to create wealth. So maybe the pre-IPO fund is a space to make quick money of 20 to 25%, but cannot actually be a space for creating wealth, because creating wealth means making a return like Nimesh mentioned, which is say 10 times in 10 years. Like last 10 years ASK's portfolio has delivered, or last 20 years what Nimesh mentioned, which requires a long term horizon. Here in this particular fund, because the fund becomes open ended after a period, for long term investors it is actually a way to build wealth. To quote an example of one of the IPOs, which is Dr. Lal Path Lab. You were talking about Anant, one of diagnostics as a sector by giving Metropolis. So Dr. Lal Path Lab is another company which came up with an IPO at 500 rupees, 2015. So if anybody would have invested maybe at a pre-IPO stage, maybe one would have made quick 25-30%. But today the stock price is at 4,000 rupees. So it's given, more than 10 times returns over last 5 years. So this is the power of listed space, which can be approached if invested into good quality businesses for a long-term period, and that is what this particular fund aspires to do.
Absolutely.
So another next question, Nimesh, why would one actually invest into an AIF structure and not a PMS structure? Because PMS structure provides access to investor in terms of holding stocks in one's demat account, looks to be more transparent and is more open-ended. Why have you selected an AIF structure for such a fund and not a PMS structure?
So frankly, the answer is, there is no difference per se. But I'll just say two things which are there. So both are great vehicles of investing. Depending on the client and distributor comfort, EOF is a pooled vehicle, an AIF, and PMS individual portfolio. But I would say there are two things why we decided to, put this in an AIF platform. First, I think fund manager gets the flexibility to buy stocks in the less than 40,000 crores market cap, and not worry about the redemption pressure, because the closed lock-in which I spoke about, I think the FM has a little more flexibility in buying not so very liquid names, which he cannot endeavor to do on the PMS side. Second reason when we try to do this AIF platform is because a lot of our clients, which are very ultra HNI clients, and a lot of consulting firms we engage with like PwC, Deloitte, a lot of promoter firms, they don't prefer to invest into direct stocks, but they prefer to do an AIF route. And that's the only two reasons that come to my mind that we came into AIF. A lot of NRI clients can participate, which can there also, but far more conveniently. Barring this 2-3 reasons, I don't think that there is any advantage between either of them, because our style of investing, our way of investing in both the portfolios remain the same.
Sure. So Anand, now the question to you, you have actually covered the kind of a portfolio that one can expect. But still, if you could give some highlight on the current view that ASK carries, or maybe you have when you are building this portfolio in terms of the preferred sectors, or maybe the top 3 sectors that you think will be, becoming part of the portfolio, and what is the indicative, I would say, return over longer term that investors can expect with the horizon of say 5 to 7 years.
So I already touched upon some of the sectors. I think what I would want to highlight starting off is that we do not invest based on sectors. We invest bottoms up. So every company we select has to meet the characteristics that we look for as per our investment philosophy that I described. So that's the first thing I wanted to mention. Sectors tend to be a corollary of where some of the great companies today are and where size of opportunity, quality of companies available, quality of management, they tend to be in certain sectors today. And so I spoke about some of the sectors, whether it's specialty chemicals, whether it is APIs, whether it is electronic manufacturing. So these are on the manufacturing side. I spoke about some of the technology companies on the digital side. I spoke about some of the consumer and healthcare companies on the unorganized to organized side. Of course, financial services I spoke about. So these are some of the sectors where we see opportunities. These are some of the sectors that the names we're finding bottoms up tend to belong to. And in terms of return potential, I think what I could offer as a guidance is that, look at the earnings growth of these companies. And so I had a slide in my presentation. If you pull it up, maybe we can highlight it again, to show the kind of earnings growth that we expect from companies that we have in our universe and in our portfolio. And so, over the long period of time, generally stock price returns tend to follow earnings growth. And so, that's I can't put a specific number on it, but looking at the past, looking at history, looking at sort of what we think the future earnings of the companies we're picking, double-digit compounding, solid double-digit compounding is something that one should expect.
Sure. And in the current context of equity markets, as Nimesh also mentioned, that one should keep a long-term horizon and one should not focus too much on price, but one should focus on earnings. But hand on your heart, I'm sure you would also have some view, and being in a 2 decade older organization, doing money management for public for last 2 decades at this level, right? So investing into mid and small cap portfolio or a flexi cap portfolio, what is the kind of suggestion or advice that you would want to give to investors in terms of say asset allocation, or in terms of what is the kind of downside risk, or what is the kind of expectation that investors should keep in mind in terms of risks, or in terms of near term, anything which comes to your mind, or which you may want to highlight to the investor to kind of balance it out.
Perfect. No, that's a good question. So I would say, speaking about the mid cap space, a leader in an industry that we look at as a mid cap can be a mid cap. Number 3, number 4 player in a larger industry can be a mid cap. Low quality company that's in a cyclical industry can be a mid cap. So, you can have all different types of mid cap. It's a very loosely used term for companies that just have a smaller market value today. So I think one has to be to differentiate between all those different kind of companies. We can't paint all the companies with the same brush. And so I would say that if the company itself is a compounder, has bright prospects, is going to compound in earnings structurally over time, that's one way to look at it, right? And the other aspect could be companies that are not, in the chart I showed, the companies that are minus 3% growth, that are either more cyclical, that get affected when times are tough. You could have a different sort of answer for those kind of companies. So unfortunately, painting a broader mid-cap valuation picture is a little bit tough to do. I think for the companies that we focus on, which is the quality end of the mid-cap portfolio, the leaders in the industries, I think for them, one has to look at sort of from a longer term perspective. Price matters, as you mentioned. We cannot pay anything for any company. That would just be silly. Price certainly matters. But I think what we're looking at is relative to the growth prospects of these companies. We are picking the companies where, the price is reasonable and where we think the margin of safety is sufficient. So, we look at valuation not from sort of what the stock price has done over the last 2 years, because that is a little bit of a myopic way to look at it, because sometimes when companies are doing well and the prospects have improved and the prospects are bright, the market started to recognize those companies. So we don't want to anchor our valuation based on past performance, past stock price performance. We want to anchor our valuation on future earnings prospects, right? Future cash flow potential, 5, 7, 10, 15 years down the line. And what are we paying for that today, right? So we sort of build that discipline in when looking at what price to pay for a business, and not so much what the stock has done over the last year or 2 years, because that is oftentimes for good reason for companies that are delivering, and sometimes for bad reasons, and those could be temporary or reversible. but we believe that companies that are delivering, and if the absolute price we are paying is sensible compared to the prospects of the business, then we're in a good place.
Right. Thank you so much. Now, this is last question for you, Nimesh. You
Yeah.
have been an author, and you have interviewed many successful people, and I have been reading all your blogs and all your I would say write-ups very intuitively. And I want you to kind of share your wisdom with us, because I am also an investor and we have this investor forum which really wants to learn, from whatever learnings you have had in your career in terms of being an author and being, interviewing all these successful people. What are the mantras? What are the 2-3 top points that come to your mind, which life has taught you, which your experiences have taught you, and which are worth I would say implementing and learning from?
Okay, interesting. And few things that, and let me bring it to the financial world, because that is what people. So I believe goal setting has been one of my biggest learning, and I would say I encountered or learned about goal setting only about 10 years back, and since then life has changed. And I'll bring it to the financial world, how it will help each one of the investors also. See, whenever I invest into a stock or a portfolio, I will always have a goal with that. So, I'm making an official disclaimer. I had bought Bajaj Finance in 2014 with a very clear indication there are a goal that my daughter after 15 years will benefit in her educations, which she wants to do that. Now, I bought it about 300, 400 odd rupees. And then what happened is the stock price ran to 1100 rupees in no quick time. And then, a lot of people I knew in Bajaj Finance called up and said, "Ye price बहुत ऊपर बढ़ गया है, बेच दे जितना बेचना है." I'm like, "What are you saying? इतना बढ़िया बेच दे करके." So, I could not sleep over it, because they're saying, अंदर वाले बोल रहे बेच दो, अभी करना क्या चाहिए? But I came back, I opened my, I said, goal setting क्या है? 12-15% बनाना है. My daughter has to receive 15 years later. So I didn't take a decision. After 4-5 days, I said, leave it. And to my misfortunes, 1100 rupees became 600 rupees in just about 10 days time. And I thought God came in the name of that Bajaj Finance guys and told me sell, but I never sold it and I have my money. It was very difficult to sleep 15 days because, I kept looking back 300 rupees, 200 rupees and back to 600 rupees. But I said, I'm still at 15%. And the journey continues from that time till around 6,500 levels, which is there. I've seen the gyrations up from 1,000 rupees, last year pandemic, 4,000 rupees to 1,800 rupees down there. Now, if I had not had a goal in my life, very defined goal that why am I buying Bajaj Finance? I would have bought and sold Bajaj Finance at least 10 times in the last, 7-8 years time. And therefore, my biggest learning in life is to do. Most people live a life where they don't know they have autopilot life. It is important to identify what you want in every area of life. You sometimes tell me, with my daughters, is very clearly that I want to spend 4-5 hours in the weekend. So that's a very defined one there, and that allows me to focus. Like in Bajaj Finance, it allows me to focus in personal life. And that is very, very critical for me at one part. I don't know how much time you have. I can actually go on and on here, but there are things like attitude, which I believe is so damn critical today. And it's a very cliche word, but I'll tell you how do you develop, and that's very critical, because every day when you get up in the equity markets, you are either down or either up, so you are demotivated. But I would say, how do you really build that attitude? I can request everybody on this call, if they can do this, I promise you 4-5 things. If you do it, after 3 to 6 months, you'll be a different personality altogether. First, after you get up and before you sleep, 2 hours after you get up and before you sleep, don't watch television, don't read media, don't watch social media. It's very difficult. But the day you get that, because everything, see in the market, if you get up in the morning and read newspaper, what's the newspaper saying? Everything negative. What's the media saying? Everything, something which has not happened right. Today, Afghanistan, everything which keeps happening right now. So before you start, you're already negative. So remember this thing, 2 hours before you go to sleep and 2 hours after you go to sleep, get up. Just avoid doing absolutely this. Second, in terms of get into playing some kind of sports or activities, because you've got to remove the stress from the financial world, where you got to jump and, because only sports allows you to completely forget what you're doing. Get into anything, yoga, meditation, exercising, whatever works for you. But ideally a sports, because when you're playing a table tennis or a carom, you don't remember what's happening in the market, what's happening in your world. So do that part, it will automatically in terms of help you in terms of really forgetting and building a very develop a habit of reading books. First thing in the morning, either you get into a spiritual book, you get into any positive book. Please do that. It will automatically bring you to a level that you are looking forward to the day, rather than looking in terms of inward. I mean, closing the day, you're looking excited towards the day. So some of the things, if you can do what it does, I think it will blow and complete. But this doesn't happen in a short time. This has to be done religiously, diligently over 3 months or 4 months to do that. And therefore, third thing, which is very relevant, is self-discipline. I think self-discipline to me is and I'll use the quote of Albert Hubbard, who said, self-discipline is the ability to make yourself do what you should do, when you should do it, whether you feel like it or not. And that's so damn powerful in that, because in equity markets, as a salesperson representative, when markets are down, I will not go and meet the clients. That's a bad idea to do. In fact, you should double or increase your meeting with the clients, because when the markets are difficult, when there's no clarity, you should do that. And that is where it requires self-discipline, doing things which is uncomfortable. So getting up in the morning is uncomfortable. Sleeping late is comfortable. Eating junk food is comfortable. Stopping that is uncomfortable. So if you can do the uncomfortable things now, then the rest of the life you will live far more comfortable. So those are the things you have to, give up some of the instant gratification to get the gratification in the future. And that happens only and only when you develop a very strong self-discipline. And again, that's a habit which you develop over a longer period of time. Maybe I'll just stop here, because these are the topics I'm so passionate about. I can keep going on for the next 15-20 minutes or an hour at all.
Well, thank you so much, Nimesh. I think it has been really insightful talking to you, and particularly understanding and learning from you. The 5 points that you mentioned. And thank you, Anant, for coming today and sharing your views and ideas on markets and on this product. And wishing you guys all the very best. I firmly believe that yes, next 10 years are the period for India to actually see and witness growth like never before. And like you also mentioned, I concur that perspective that next 10 years bring more potential for wealth creation than last 10 years. The one that will differentiate one investor from another investor is the discipline. Absolutely. And the quality approach. And that is exactly what attitude is all about. And being in the hands of ASK investment managers, that becomes very easy. And that is where I would want to end up. Thank you everyone for joining us today. All the very best.
Thank you, Kamal and PMSI.
Thank you everyone.